The US debt ceiling is a regular source of worry for equity markets, so in this video we'll look at why this time around it could potentially be worse than it has been in the past, but also how there's a beautiful workaround for the debt ceiling in the form of the $1 trillion coin. So let's look at the US debt ceiling in a bit more detail. Before we begin, let's just quickly go through the three main characters in this drama of the US debt ceiling. The first one, and possibly the most important one, is US Congress. So these are the lawmakers who sit in the House of Representatives and the US Senate, and they set the fiscal policy for the United States. That's how much money the US spends and what it spends it on. The second important player is the US Treasury Department under the leadership of Secretary Janet Yellen. Now their job is to actually dole out the treasure which is collected through taxes and also to issue debt to raise capital for running the government. But another important role of the Treasury, which will come into our story later on, is that they control the US Mint, and that's responsible for creating the actual physical currency in the form of coins and bills. And then finally, we've got the US Central Bank, the Federal Reserve, under the leadership of Jerome Powell. Now, their job is to set monetary policy, that's interest rates, and to try and keep inflation under control and to keep employment at its maximum level. Now, another role for the Federal Reserve, which will come into our story at the end, is that they're responsible for taking the coins and the bills which have been printed by the mint and distributing that to banks. Now let's turn to the debt ceiling itself. In 1917, the US needed to raise money in order to fight in the First World War. And here's an advertisement which was published at the time in order to make people buy these 1917 war bonds. Now, up to that point in time, it was the job of Congress to agree every single bond issue from the US Treasury. That meant they'd have to pass a law which would set the actual coupon of those bonds, that's the interest that they'd pay, as well as its maturity, which is when the money would be repaid. So in 1917, it was decided that that was too restrictive, and the US Congress passed the Second Liberty Bond Act. And that set a limit on the aggregate amount of US debt which could be issued. But it wasn't carte blanche for the US Treasury, there were limits on specific debt issues. But then in 1939, with the advent of the Second World War, this was relaxed even further, and there were just limits on aggregate debt. Now the limit at that time was just $45 billion, which seems ridiculous now because the current debt limit is just over $28 trillion. This graph shows you the history of the debt limit since 2010 for the US, and you can see that it's gradually been creeping up over time. Now the grey areas show you where the debt limit's suspended, but you can see when those suspensions end, or when the debt hits that limit, then you have to enter this period called extraordinary measures, which we'll see in a sec. And these red dots that you can see are called near misses. That's when US Congress almost didn't pass a bill to raise the debt ceiling in time, and the US Treasury could have run out of money and defaulted on US Treasuries. Now, a US Treasury default has not happened in the entire history of the United States. And since 1960, there have been many times when that debt ceiling has been raised. In fact, that's actually happened 78 times. And it's not just one party which is responsible for raising the debt ceiling. In fact, under Republican presidents, it's happened 49 times, and under Democratic presidents, it's happened 29 times. But it's looking like this time around, it's going to be another near miss. This is the timeline in 2021 for the debt ceiling, and you can see at the end of July, there was actually a 2-year suspension which ended on the debt ceiling due to emergency measures for the pandemic. Now, Congress didn't approve a raising of the debt ceiling in time, so now the Treasury's gone into a period of time called extraordinary measures. This is a way for them to scrimp and save in order not to spend too much so that they don't hit the ceiling. If Congress doesn't agree a raising of the debt ceiling in time, then what's probably going to happen from the beginning of October is we'll get a series of temporary government shutdowns. This is a letter from Janet Yellen to the Speaker of the US House of Representatives. And what she's talking about here is when the money's going to run out. And what Yellen's saying is that the cash and extraordinary measures will be exhausted during the month of October. So that really isn't giving Congress very long before they're going to run into real trouble. And the prospect of a US debt default starts to become a very material risk. And you may be thinking, is a default on US Treasuries such a bad thing? Is it a big deal? As Janet Yellen recently said in testimony to Congress, I think defaulting on the national debt should be regarded as unthinkable. You may be wondering, what would the consequences be for this unthinkable act of allowing a US default? The reason why US Treasuries are so important is that they are considered to be the risk-free asset on which every other asset's pricing is based. And I've represented that here as a Jenga tower, with US Treasuries forming the block at the bottom, which effectively supports all the other risky assets piled on top of it. Because if you look at the pricing of any asset anywhere in the world, it will be affected by Treasuries. So that would include investment-grade corporate bonds, high-yield corporate bonds, stocks, real estate, in fact, everything. At the core of any discounted cash flow model for any asset on the planet, you'll see US Treasury rates somewhere in that model. And if US Treasury yields increase, that reduces the value of future cash flows for every one of those assets. So there literally is no asset on the planet that would be untouched by a US debt default. Now, it's not often you see a tweet from the US Treasury Department which uses the word cataclysmic, but here is one of those tweets. And it actually quotes research by Moody's, the rating agency, which shows the consequences of not raising or suspending the debt limit. Here's the chief economist from Moody's, who's Mark Zandi, and what he says is that global financial markets would be upended, and even if there was a default and it was resolved very quickly, he says Americans would pay for this default for generations. And if we look at the analysis by Moody's, this is what they forecast would happen to US GDP. Relative to a non-default scenario where the debt ceiling was raised, they think that GDP would fall by 6 percentage points. That's absolutely massive. Not only that, but it would be a very long-lasting effect. So you can see it persist for several years after that big peak in 2022. And relative to a non-default baseline, unemployment would also spike by about 4.5 percentage points. But they also look at what would happen to the S&P 500, and by their estimate, it would fall by around 30%. Now, normally Treasuries would form a hedge for an equity market fall, but not in this case, because yields on Treasuries would also spike by about 1.5 percentage points. And remember, if the yield of a bond goes up, the price goes down. So this would be a simultaneous fall in US equity and in US Treasuries. Now, the reason for that is because Treasuries would no longer be seen as safe. This instrument, which hasn't defaulted in the entire history of the country, would suddenly be much less reliable. Given the stakes and the unthinkable consequence of not raising the ceiling, you might think that politicians would never risk that outcome, but it actually looks like we are going to go to the wire again. If you're enjoying learning about investment with our YouTube videos, then an even better way to learn, which is more interactive, is by joining our Patreon community. To learn more about that, click on the link beside me and in the description below me. Now, the last time the US had a close shave with a debt default was in 2011. So this graph tracks the value of the S&P from July in 2011 through to the end of the year and the beginning of 2012. And you can see there was a pretty big dip in the S&P 500. So this certainly had people worried at the time. Now remember, this time around there was no default, but it got very, very close. So the dashed red line you can see was the date at which Tim Geithner, who was Treasury Secretary at the time, said that money would run out. And the really big sell-offs happened as we got closer and closer to that deadline with very little action from Congress. But you can see that equity markets sold off even after the US debt ceiling was raised. So why would that be? This was a story on Reuters, which in 2011 said that there would be a raising of the debt ceiling. And yet after this, we still saw equity markets sell off. And the debt limit was raised literally hours before the deadline set by the Treasury Department. The act itself was called the Budget Control Act of 2011. And at that time, the debt ceiling was increased to 16.4 trillion. But the fact that Congress had gone so close to the wire made rating agency S&P downgrade US debt. So this was from the highest quality, AAA+, down to AAA. Now, as we get closer and closer to that day when extraordinary measures would be exhausted, and the Treasury said it would exhaust its borrowing capacity, you can see that the yields on these bonds gradually increased over time. So you can imagine if we did have an actual default, those yields would just spike to very high levels, and that would reflect a higher cost of borrowing for the US government. And this is why this effect could last for generations, because it would increase the cost of borrowing for a very long period of time. Now, this time around, there are reasons to worry. Normally, these extraordinary measures give Congress a little bit of time in which to act. But this time around, as Janet Yellen said when she wrote to Pelosi, there was heightened uncertainty related to the economic impact of the pandemic. If you look at the monthly statements from the US Treasury, you can see their expenditure here month by month in 2020 and in 2021. You can see in April and in June in 2020, but also in March in 2021, there were some extraordinarily large spikes in the amount of expenditure. So it's possible that the cash reserves of the Treasury may have been depleted by those extraordinary expenditures. And at the same time, we have very polarized politics in the US, such that it's very difficult for Republicans and Democrats to agree about anything. So maybe we need to look at other ways of avoiding a political impasse, and minting the coin is one way to do that. To understand how this works, you have to understand something called seigniorage, which is simply the profit made by the US Mint when it creates coins, for example. So it'll cost the US Mint a certain amount to create each coin because they have to pay for the metal and for the production process. But then the difference between the face value of the coin and the cost of manufacture would be considered the seigniorage profit. So the way this works is that the US Treasury is responsible for creating the physical currency. So the process would be that the mint would create the actual coin, and here is that coin, but then the coin, once it's manufactured by the mint, is passed on to the Federal Reserve, because it's their job to actually distribute that coin to banks. And for example, in 2019, you can see that seigniorage generated $500 million for the US Treasury. There are actually very strict rules as to what kind of coins and the denominations of those coins which can be created by the US Treasury. But there is one exception, and that's platinum bullion coins. What's different about these is the Treasury can set the denomination to be anything it wants. So certainly in theory it's possible to create a $1 trillion coin. Now the seigniorage on this would be absolutely huge. It wouldn't be much less than $1 trillion. The actual size is irrelevant. It could be a tiny coin. So the actual cost of manufacture would be negligible. So now if you see people say mint the coin on social media, you'll know exactly what they mean. It turns out that a spokesman for the Biden administration has actually said they're not going to use the $1 trillion coin option. But who knows, if it goes down to the wire, that might be the only way to avoid a default. Let's just hope that the politicians come to their senses and avoid what would undoubtedly be a disaster for the US. So if you do want to support us, a great way to do that is by just clicking on the thumbs up for this video and by subscribing to our channel. And as always, thank you for listening.